Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 29th of March 2016, and we're putting the case as to why the US Federal Reserve could justify raising interest rates. Now, before we do that, we wish to point out that we do not believe it will happen in April, but it's possible, and that any rate rise would be limited to 0.25%. Here are some justifications for such a rise. 1. Increasing inflation. Year over year, core CPI, which is excluding food and energy, came in at 2.33%, up slightly from the previous month's 2.21%. This is important because the Bureau of Labour Statistics pointed out in its 16th of March report, quote, "The energy index continued to decrease and was the major cause of the seasonally adjusted decline in the all items index, more than offsetting increases in the indexes for food and for all items, less food and energy," unquote. In other words, if it had not been for a reduction in energy prices, overall inflation would have been higher. We all know that one of the main ways of dealing with increased inflation is to raise interest rates. And it would only take a relatively small rise in oil prices to raise the overall inflation data up to and beyond the targeted 2%. 2. Employment data. Total non-farm payroll employment increased by 242,000 in February of 2016, higher than an upwardly revised 172,000 in the previous month and beating market expectations of 190,000. The unemployment rate was unchanged at 4.9% and again was within the Fed's target of below 5%. The number of Americans filing for unemployment benefits was 265,000 in the week ended March 19th, an increase of 6,000 from the previous week's revised level of 259,000, while staying below market expectations of 268,000. This marks 55 consecutive weeks of initial claims below 300,000, the longest streak since 1973. 3. Stock market levels. One of the concerns that the Fed has when raising rates is the impact on exports as the result of a rising dollar and its consequential effect on the stock market. Well, interestingly, we took a look at the Dow Jones Index and the S&P Index on the day interest rates were raised, on the 17th of December 2015, the last possible moment the Fed could raise rates in that year, and was the first time rates have been raised for 7 years. On the 17th of December, the Dow Jones Industrial Average Index closed at 17,495. And yesterday, the Dow Jones Industrial Average Index closed at 17,535, some 40 points higher. On the 17th of December, the S&P 500 Index closed at 2,041, and yesterday it closed at 2,037, just 4 points lower. So what is the point we are making? Well, everyone has said that raising rates means the stock markets will crash. Well, they haven't. Yes, they did go down initially, and 3 months later, they are back to where they were. Now, we can debate whether this is manipulation or not all day. Nevertheless, you can be confident that the Fed will see this as a controllable event and may indeed be tempted to raise rates again, knowing that its impact may only be momentary and will help ease any bubble which may be developing. 4. Imports-exports. Data published yesterday showed that the US international advanced trade deficit in goods increased to $62.9 billion in February from $62.4 billion in January, as imports increased more than exports. The 3-month moving average in the US international trade in goods and services show a similar picture. Now, this would normally suggest that the Fed will be cautious about raising rates, so as not to strengthen the dollar further, which would likely result in lower exports and higher imports. That said, it has to be borne in mind that the United States has been running consistent trade deficits since 1976 due to high imports of oil and consumer products. In recent years, the biggest trade deficits were recorded with China, Japan, Germany, and Mexico, and the trade surpluses with Hong Kong, Netherlands, United Arab Emirates, and Australia. 5. Value of the dollar. On the 16th of December 2015, the day prior to the interest rate rise, the dollar index stood at 97.88, and after the rise it rose to 99.32. Today, the dollar index stands at 95.2, some 2 points lower than before rates were raised last year. It would therefore not be out of order to believe that rates could be raised again, and yet the dollar remain within that 95 to 98 level, thereby not hurting exports that considerably. So, with all of these variables, are rates likely to rise? Well, Atlanta Federal Reserve President Dennis Lockhart said on the 21st of March, quote, "The Federal Reserve could hike rates as early as next month." Unquote. He also said he expects continued job market improvements this year. He is optimistic the Fed's 2% inflation target is possible in the medium term. Earlier the same day, Richmond Fed President Jeffrey Lacker took a similar tone on inflation, saying it will likely accelerate in coming years and move towards the Fed's target. He added, quote, "US inflation was bound to increase significantly after the price of oil bottoms out. Inflation outside food and energy would move back towards 2% once the US dollar stops appreciating." Unquote. More than 4/5 of economists polled recently by the Financial Times said the Fed would lift rates 2 times or fewer this year. One believed the Fed would be forced to cut rates by December. They believe the uncertain outlook for global growth will not stand in the way of the central bank resuming its path towards normalization in June. However, earlier today, Janet Yellen stated in a speech at the Economic Club of New York, quote, "Volatile oil prices and China's slowing growth, coupled with how soon domestic inflation would reach the Fed's 2% goal, were key factors guiding the Fed towards taking a gradual approach on raising rates." Unquote. Omer Essner, chief market analyst at Commonwealth Foreign Exchange, said, quote, "On balance, Yellen's comments do not sound consistent with a looming rate hike in April and leave considerable doubt about whether rates will rise in June. Given that her tone contrasts what we heard from various Fed speakers last week, Miss Yellen's comments are likely to prove, once again, frustrating for dollar bulls, unquote. Our view is quite simple. Providing the government statistics are accurate, another 0.25% rise in interest rates is quite possible, based on the factors already mentioned. We feel, however, that the Fed wishes the dollar to remain at current levels for the time being, to aid exports, and meanwhile, Yellen and her fellow Fed members will continue with the hawkish and dovish comments to manipulate the dollar value without having to raise or lower rates. Nevertheless, we stick by our forecast that rates will rise once this year. When, no one knows. But the Fed realizes that it has to be seen to follow through at some stage, as it did last year, in order to maintain its credibility. For interest, silver prices fell earlier today to as low as $15.07, and now stand, as a result of Yellen's dovish comments, at $15.34. Who says no one cares what she says? The FOMC next meets on April the 26th and 27th. What do you think will happen then? We hope you found this video interesting and informative, and if so, please give it a thumb up and share it on Twitter. Also, kindly visit our website at www.illuminatisilver.com and look at our Facebook page, which is updated daily at www.facebook.com/IlluminatiSilver. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.